Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. For the week ending May 27, 2022, the market was up very sharply. In healthcare, biomedical, drugs, and healthcare all advanced. In media communications, internets, media, and telephones advanced. In technology, semiconductors advanced and crossed to the bull side, and the other three tech sectors advanced. In consumer discretionary stocks, all six sectors advanced. In the financials, all six sectors advanced. In the industrials, all seven sectors advanced. In the others group, oil and oil services advanced, gas utilities and transports advanced, food and business products advanced. On the bull side, electric utilities, forest products, textiles, and protection advanced, and precious metals was unchanged. For the week, we had only one sector unchanged, precious metals, and 39 sectors advanced. One sector, semiconductors, crossed from the bear side to the bull side. There are now 6 sectors on the bull side and 34 on the bear side. For the week ending May 27, 2022, the S&P 500 closed at 4,158, up 256 points, or 6.5%. The Dow Jones Industrial Average closed at 33,213, up 1,951 points, or 6.25%. The Nasdaq closed at 12,131, up 776.5 points, or 6.84%. For the week, we had 534 stocks went from sell signals to buy signals. Our number of listings declined by 8. There are now 32% of stocks on buy signals and 68% on sell signals. Overall, the market score last week was 15, and this week it's 30. For the first 21 weeks of 2022, the S&P 500 is down 12.76%, and NASDAQ is down 24.96%. Energy is up 59.5% year to date, and is far and away the best performing sector. For the first 21 weeks of 2022, healthcare is down 6.3%. Media communications is down 22.5%. Technology is down 21.3% year to date. Consumer discretionary stocks are down 24.8% and is the worst performing sector of 2022. Finance is down 10.4%. Industrials are down 9.77%. Real estate stocks are down 15.9%, and basic materials are down 5.79%. For the past week, the S&P 500 was up 6.6%, and NASDAQ was up 6.8%. The two best performing sectors were energy and consumer discretion. Consumer discretion was up 9.5%, and energy was up 8.3%. The two worst performing sectors were healthcare, up 3.3%, and media communications up 3.8%. Tech was up 8% this week, and consumer discretion 9.5%. Financials were up 8%, industrials up 6.4%, real estate was up 5.8%, and basic materials were up 6%. For the week ending May 27th, 10-year Treasury bond yields ended at 2.743%. This mainly reflected the large sell-off in stocks and subsequent money market purchases that get triggered automatically. For the week ending May 27th, West Texas Intermediate crude oil closed at $115.07. Year-to-date, WTI has risen 53%, and RBOB, wholesale gasoline, has risen 80.2%. Crude and wholesale gasoline began diverging in March. This indicates to me that margins are rising at the refinery, distribution, and retail levels on top of the price increases at the wellhead of crude oil. That's the harmful effect of inflation. Prices go up at the wellhead, and every level from the wellhead to the gas pump has to increase prices in order to maintain their profit margins. That's how you see a differential between 53% and 80%. It's debatable how much is actually additional profit, if any. It works the same way in every industry. Food, for example, soybean prices go up. Every level from trucking to the food processor to wholesale distribution to the retailer has to raise prices to maintain profitability on cash flow. Greed always enters into the picture somewhere along the line, and players try to raise their gross profit margins. This is a chart of the S&P 500 and NASDAQ year-to-date. Using a Fibonacci series analysis on the indices, this rally is just about over. The S&P 500 should top out this week at about the 4,230 level and NASDAQ close to 13,300. As I'm writing this, futures indicate an open on Tuesday of 4177 for the S&P 500 and 12,810 for NASDAQ. This market since January 1 has followed the Fibonacci series predictions quite accurately. This is the point and figure stock chart. The X columns indicate rising price. The O columns represent a declining price. The red dots are the bullish support trend line, which defines a positive trend. When the stock goes below the bullish support line, it's a positive trend break, and the stock is then in a negative trend. The break also established the bear resistance line. When a stock is in a negative trend and hits the bear resistance line, it often breaks down sharply and quickly. Stocks can often go months or even years without hitting a trend line. During this 17 months in a positive trend, the stock gave 11 buy signals and 3 non-consecutive sell signals. Then it did 2 consecutive sell signals, a trend break, and a third sell signal, and then it dropped from $108 to $69. When tracking the 500 stocks of the S&P 500, I normally expect to see only about 5 to 20 stocks at or even close to the trend line each day. When tracking the 500 stocks of the S&P 500, I normally expect to only see 5 to 20 stocks at or even close to the trend line each day. On Wednesday, there were over 80. By the close on Friday, May 27th, there were about 35 that had exceeded the bear resistance line, and most of those that overshot and had already come back to the bear resistance line. Including those 35, over 220 S&P 500 stocks are at or nearly at the bear resistance line. The technical traders are seeing buy signals, but I'm seeing very few actual clear breakouts. Now think about it. Wholesale gas, energy, is driving inflation up sharply. Food prices are rising sharply. Car prices are soaring, including used cars. Autos, food, and energy are the second, third, and fourth largest household budget items after mortgage and rent. I'm 90% certain this is a bull trap in a bear market. I just don't know if the trigger will be in the jobs numbers later this week or next week's producer price index and consumer price index numbers. Could be something else, who knows. But this is a bull trap if I've ever seen one. Subscriptions are available for $12 a month on an annual contract or $15 a month on a month-to-month contract. I've been producing the Slay the Spider Circle since 1998 and using it to manage private client assets. I've been nearly completely out of stocks for the past year. My portfolio performance is now well ahead of the S&P 500 and NASDAQ indices since I went into cash. That's the total idea behind Slay the Spider. Outperform the indexes in both up and down markets. Now is an excellent example of cash beating the market substantially. I'm looking forward to buying many of the stocks I owned previously at prices well below what I sold them for last year. I will then own more shares going forward, in some cases twice as many. Sure, there were a few stocks I wish I had kept, but in total, I'm more than happy avoiding this bear market.